Yields are flying. They've been surging through March. We've got hawks all over the place and big tech has rallied. Walk me through piece by piece why this has been happening from your perspective.
Well, there's a concern about an upcoming recession. It's not the Goldman Sachs economic forecast, but certainly in the minds of many portfolio managers, that is an increasing risk. And that is one of the reasons why their attractiveness of some of the largest technology stocks and some of the more durable earnings companies in many different sectors, but we'll focus on tech for just a minute. And I believe that is a key kind of underpinning thesis for why the stocks have done well. We are about to embark on the first quarter earnings season that will kick off around April 11th or so. And I believe that there's going to be a significant number of negative earnings surprises. In fact, you probably get a large number of pre-announcements in the coming weeks just before the earnings season. The reason I believe that is that it's been a particularly difficult quarter from a operational point of view for management. So you think about the first month of the year in January was largely overshadowed by Omicron, and then you had the higher rates that really kicked in February, and then you have most recently the tragedy in the war in Ukraine. So you have these events that have really impeded a lot of sales for a lot of companies, and I think managements have been reluctant to give guidance, understandably, because things are really swiftly moving. And so I think that's a question on the prospect for earnings. Jonathan, the earnings revisions have been negative for most sectors in the market in the last month. And frankly, they've been pretty tepid for the full year in the first 3 months. But the most recent kind of activity has been downward earnings revisions. And I think that is a concern about on the part of many portfolio managers and which companies have the probability of actually delivering on expectations. And therefore, a lot of the technology companies are perceived as having more stable prospects of earnings.
Do you share that view, though, just on tech? I mean, you've got this view that we're going to get some earnings warnings here, David. Where do you think those warnings will be concentrated?
Well, I think you want to, then I feel very strongly, you want to break the technology sector into a couple of pieces. One is profitable, growing companies, and there's a large number of unprofitable companies that are still growing their revenues and forecast to grow revenues quite sharply. Jonathan, those two groups of stocks basically trade at the same valuation level, around 7 times enterprise value to sales. That is sort of inconsistent in terms of a normal valuation, well-ordered market. Normally, if you have corporations and a bunch of companies that are growing at 20% top line with very high margins, say north or above 20%, and then have a group of stocks where they're also growing rapidly, but they're very thin margins, perhaps losing money, those should not generally trade at the same level of valuation. And therefore, I think there's more risk in some areas in technology. Where you're likely to get some of the weaknesses, probably in some of the consumer discretionary oriented and facing companies, some of the consumer staples areas where the consumer has been is challenged in this environment. So we think about where that's weak expectations on profit growth. That's an area that we would be concerned about. Obviously, another area is some of the companies that have a lot of revenue exposure towards Europe, as compared with companies that are primarily domestically facing. That's another kind of split in the market in terms of investor focus, which I happen to be focused on a lot with conversations. Dividends would be another area of focus. Those companies that have both increased their dividends already since the start of the year and are forecast to have kind of increased dividends hikes this year generally offer some ballast and some insulation to some of the broader macro issues of a decelerating economy. I think the general environment is you have weakening profit growth, and you have a higher interest rate environment. And in my calculations, with a 10-year U.S. Treasury yield, nominal yields at around 2.7% at the end of this year, and the economic forecast that we're assuming, which is deceleration the rest of this year, that supports around 4,700 level for the S&P 500, which is very limited upside. Yeah. Whereas in contrast, if you had a recession, you'd be closer to, say, 3,600, much lower. I think the distribution of risks right now is more to the downside than the upside, given that combinations I just mentioned.
Interesting. Well, I'll come back to the rates call in just a moment. You mentioned the consumer. I think that issue is multifaceted because going through your research as well, you also talk about the household allocation to equities today. relative to recent history. And David, I wonder, if the consumer makes you worried about consumer spending, does it also make you worried about household allocation to equities, which has been supportive of this rally year to date?
Well, it's a situation from an asset allocation point of view that it's not just for the consumers. If we kind of expand that for a moment to think, in addition to mutual funds and pension funds and foreign investors, collectively, those categories, they control or they own or they represent about 90% of the ownership of the U.S. stock market. Obviously, the major portion of that, about 38%, is comprised of consumers. Those entities have around 50% of their asset allocation to equities, about 20% to bonds, and around 12% to cash, balance being gold and commodities, things like that. But those three major categories, where else is one going to be allocating money in this environment? With the bond yield forecast that we have at Goldman Sachs, rising rates means it's a real headwind for getting a positive return in the fixed income market. Cash likely to continue to get a better return as the Fed continues to hike rates. But in the equity market, broadly speaking, there's a bias in favor of that from a risk premium point of view. So at the end of the day, we think about the opportunity set in equities, modest upside, admittedly, I think relatively, also some downside. Obviously, there's a distribution of some risks.
Sure.
But the balance sheets of a lot of companies are very, very strong, and they're buying back a lot of stock, which is the other supportive attribute of equities at this point.
David, not every research department is fully aligned between rates, the economists, and the equity strategists, but I want to pick on your rate strategist just for a moment. They've got curve inversion year-end this year, year-end next year, and year-end the year after. David, that's a very strange dynamic to have that consistently through the next 2-3 years. I want to understand what that means to you from your perspective, even if you don't agree with it. And you can say if you do or you don't. But even if you don't, I want to understand if that's going to be the case in rates, what does that mean for stocks?
Well, it means that the trajectory of increase in the level of the market or decrease in the market is going to be a function of profit growth. It's incumbent upon companies to deliver better earnings, probably through margins. And the reason for that, Jonathan, is the idea of a decelerating economy means that the challenge for companies is to generate revenue growth as the economy is slowing. So therefore, there's much more focus on the margin structure. And what you are seeing now and what you are likely to continue to see this year is corporate spinoffs. That's likely to be the major corporate finance development, in my opinion, as you see the balance of 2022 continue, because corporations are thinking about ways to improve their margins and create value for shareholders in an environment when the economy is decelerating, getting higher sales is more difficult. Now, coming back to your question about rates, the idea of valuation headwinds, that's basically what a higher rate environment is going to entail. You've got higher short rates, you've got higher long rates, you have a yield curve that is basically, bear flattener in terms of the trajectory and reshaping of the curve. That's a more challenging environment for equities. The companies that are buying back a lot of stock, likely to be an area that outperforms in that case. Companies that are paying dividends, also a way of thinking about that. The overall index, Jonathan, is likely to be a shallower trajectory of upward, generally speaking, upward move in the equity market, because the economy generally is still rising. We are not anticipating a recession, although the
Sure.
a inverted yield curve would suggest that is certainly a risk. That's one of the reasons, many reasons why, but that's a particularly intermediate risk why investors are so focused in this area.
Can I finish on this question, because I know you've got to run, David? Are you losing conviction on your year-end price target? Just going through this conversation with you right now, how high is your conviction on that call right now at 4,700?
Well, there are a couple of ways to think about it. Number one, we have had the best 2-year return in 75 years. The U.S. equity market has doubled in value from the low of the pandemic. That's a better 2-year return than you had coming out of the financial crisis, and it's a better 2-year return than you had coming out of the 1974 bear market. So it's been a particularly, powerful rally, and the idea of margins at record high levels with all of these headwinds on supply chain disruptions, commodity prices, labor costs, these challenges have made it harder for a lot of managements to navigate in this environment. But we're not anticipating a recession. So therefore, the history shows, Jonathan, when you are a buyer of the equity market, when it goes down by 10%, and recall we've been down 13% from the high on January 3rd, down 13%, the market typically rallies back to just about the peak of where it was in the next 12 months. So therefore, if 4,800 was basically the high on January 3rd, our forecast of 4,700, a little bit below that, at the end of this year is consistent with what has happened historically. That's not how we arrive at the forecast, but you ask about the conviction.
Of course.
That's generally the trajectory that I would anticipate the market, kind of haltingly getting towards later this year. Remember, you'll have a lot of hikes in the near term, but we'll have a midterm elections in November. And when you look at the end of the year, that will then be behind us. And so looking forward, I think that's the idea, and that's the building blocks behind our forecast.